Gentlemen, welcome to Bottom Line. Thanks for coming on today.
Thanks, Mark.
Our pleasure.
The aftermath of Friday's jobs report and the market volatility. Guys, where are we? Scott, let's start with you.
Well, I tell you, Mark, really, we had been talking to our clients about using a pullback, which we felt there was good support in that 1280 to 1300 range for the S&P 500. We wanted our clients using this pullback as an opportunity to get set up really for what we feel is the next leg up in this cyclical bull market. So, we're buyers in here. I think that, clearly there's a lot of uncertainties going on in Europe. People are fearful after we get a jobs report like we just saw. But overall, we're positive here when we look out over the next 12 to 18 months. We want our clients buying cyclically sensitive stocks. Just happens to be the ones that have been hammered the most in this pullback.
David, what's your perspective?
Well, I'm not quite that optimistic just yet. I think in 12 months' time or so, stocks will be higher than they are now. But I think I'm afraid we may have further to drop here just in the immediate term. And by that, I mean the next couple of weeks, maybe the next couple of months, just because of the policy uncertainty. But I do also think that we're a little bit closer to perhaps a policy surprise that may put in a floor on this market. So there is some risk in being on the sidelines. In other words, I think maybe the ECB could do something on Wednesday, the Fed maybe in a couple of weeks. We don't know. But I think the risks of that happening are certainly increasing given the weakness here.
Well, Scott, the recession officially ended 3 years ago this month. Is what we're seeing in the markets right now an aberration or a correction? We saw the same mid-season, or if you will, mid-year slump in 2010 and 2011.
Well, Mark, I think it's a correction within a cyclical bull market, and so I think that if valuations were high, which they're not, if interest rates were going up, which they're not, if we didn't have a chance for some sort of positive policy progress which David just mentioned, and I think is definitely a possibility in the next few weeks, then we would be more negative on the market, or at least not as optimistic as we are. But we have a 1400 to 1450 target out there for year end. I think that's doable. We need a little help from Europe. We need a little policy help. I think we're probably going to get it.
David, let me ask you, given what our colleague Peter Cook and Michael McKee were telling us just a few moments ago, given the current economic conditions, is there any way that you see the Fed raising benchmark interest rates before 2015?
3 months ago, I would have said definitely. In fact, I would have expected it to happen maybe sometime next year. But this environment has taken a decided turn down. And by that, I mean that all of a sudden now we're starting to see some real signals that a deflationary episode may be upon us. You see it obviously in bond yields, but you see it in money supply growth starting to slow. You see the commodity prices dropping. And it's not just Europe that's driving us lower, it's China as well. So 2015 is an awfully long way out there, but I think that it's becoming a little bit more realistic that the Fed may be on hold as far as they've been saying into 2014, and who knows what happens in 2015.
Well, let's talk about bonds, because you just broached the subject. Scott, U.S. and German government bonds, they have been the beneficiaries of investors' nervousness about the equity markets. The 10-year here in the U.S., the yield hit a record low last week of 1.46%, and the rate on the German 10-year is at 1.17%. Are treasuries overvalued, and how long will these record low yields last?
I think treasuries are expensive, in my opinion, versus stocks. But, the bond market's telling me that we're in for an extended period of very modest growth with very modest inflation. And David brought up the topic of deflation. And I guarantee you this whole last 2.5, 3.5 years, there's many members of the Federal Reserve that are worried about deflation. When you have real wage gains negative, that's a big contributor to this, and I really think that that deflation fear has never left the minds of many Fed members. But for me, we're in a very modest growth, very modest inflation period for a long, long time, and it's not good that bond bond rates are down here. I mean, if we're at 1.5, 1.7% 10-year yield a year from now, there's going to be a lot of bad things that have happened.
Well, David, speaking of overseas, if voters in Greece reject the terms of that $170 billion bailout when they go to the polls this month, what's the ripple effect in global markets going to look like?
Well, first of all, it won't be good. It's a question of exactly whether or not a coalition government can be formed that allows Greece to stay in the Eurozone, and while also accepting the terms of the bailout. If, however, that's not the outcome of the vote, I think it's only going to accelerate the market downturn in Spain and in Italy. And it's going to keep policy uncertainty right at the forefront. So under those conditions, I would expect the ECB to get much more proactive and put aside some of their reluctance that they've shown so far in determining their strategy and what their authority is. But it won't be good, certainly.
Gentlemen, I have about a minute left. I'm sorry, but I've got to ask you just briefly, both of you. Scott, let's start with you. By the end of the year, if the White House and Congress don't reach an agreement on the Bush tax cuts, and if those automatic spending cuts kick in, is the U.S. economy poised to slip into another recession?
Well, Mark, I think whether they announce it at the end of this year with the lame duck Congress or if they retroactively do it, I do believe that they are going to address this. They're going to extend everything. If they don't, believe me, it's going to hurt the economy badly.
And David, I'll let you get the last word.
Yeah, I agree. I think it gets done in the lame duck session. They kick it down the road to maybe June or July. And that gives us a nice 6-month window on the political calendar to get something meaningful done on deficit reduction. I think that's our best chance.